Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Let's dive in. You're on the couch. It's late. You've been scrolling listings for, 3 weeks? Everything's either overpriced or needs a new roof. You're about ready to close the app. Then one catches your eye. 4 bedrooms, 3/4 acre. There's a pool, priced right. And there's this one line in the description you've never seen before. Assumable FHA mortgage at 3%. You have no idea what that means. A single dad in Maryland saw that exact line last year. His name's Gavin. He's 42, runs an auto repair shop. He Googled that phrase, called his agent the next morning, and closed the deal. Now he's paying $500 less a month than his neighbors. $500. Same street, same zip code, completely different payment. He stumbled into it. You won't have to. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. Today, 6 million homeowners in this country are sitting on something they don't even know about, and almost nobody is taking advantage of it. There is a catch, though, one thing that trips people up. I'll get to that. But first, what is the 3% hack? I'm not a mortgage broker. I'm not an attorney. This is education. Don't try any of this without a lender you trust on your team. We clear? Good. Okay, so an assumable mortgage. Simple idea. You take over the seller's existing loan, their rate, their balance, their repayment terms. You step into their shoes and the bank says fine, as long as you qualify. Now, not every loan works this way. Conventional mortgages, your typical Fannie, Freddie stuff, they've got what's called a due on sale clause. You sell the house, the loan dies. Done. But government-backed loans, VA, FHA, USDA, those have been assumable for decades. VA loans since 1944, it's written right into the contract, and nobody talks about it. Here's why that matters to you right now. The average assumed rate today is 3.2%. The going rate on a new 30-year fixed, about 6%. Same house, same street. But your monthly payment nearly cut in half. Think about what you do with that difference every month. And the scale of this, honestly, it blows my mind. There are 12 million assumable mortgages in America right now. Guess how many people actually assumed one last year? 6,400 out of 12 million. That's 0.05%. The door isn't just open. There's nobody in the building. So why? Why is nobody doing this? I call it the 4-3-3 versus 3 problem. There's a company called Rome. They specialize in assumable listings. They searched Houston for homes with assumable rates under 3%, found 433 listings. Then they ran the same search on Zillow. Zillow showed 3, not 300, 3. Because Zillow waits for sellers to tack their own listing. And most sellers have no idea their mortgage is assumable. Their agent didn't tell them. Their lender sure didn't. Here's my point of view. That rate sitting on someone's loan, it's not just a number on a statement. It's a transferable asset. We're talking hundreds of thousands of dollars in savings over the life of the loan. I call it rate inheritance. You're inheriting someone else's locked-in rate. And right now, almost nobody's claiming it. All right, I told you there's a catch. Here it is. When you assume a loan, you're picking up the remaining balance, not the full price of the house. Let me put some numbers on it. Say the home's worth $450,000. The FHA loan sitting on it, $280,000 at 3.25%. That means there's a $170,000 gap between what the loan covers and what the house actually costs. $170,000. That scares people. I get it. But here's what most people miss. You don't have to cover that gap in cash. The move I like best, seller carryback. You ask the seller to hold a second note. They finance that $170,000 themselves. They charge you, say, 7%. Sounds high, right? Okay, stay with me. When you blend the two loans together, $280,000 at 3.25% and $170,000 at 7%, your effective rate across the whole purchase comes to 4.67%. Think about that. That's still a full point below what you'd get at walking into a bank today. On this house, you're saving over $300 a month. Over 30 years, more than $100,000. The gap is a math problem. It's not a wall. Now, investors, this part's for you. I need you to pay attention here because this is where the numbers really change the picture. Take a $300,000 rental, rents $2,200 a month. Taxes and insurance run about $500. Assume that loan at 3%, and your DSCR, that's your debt service coverage ratio. It's how lenders measure whether the rent covers the mortgage. Your DSCR comes in at 1.25. That clears the new minimum we talked about in episode 113. Now, go get a brand new loan at 6% instead. Same property, same tenants, same rent check. DSCR drops to 0.96. Deal's dead. The rate alone decides whether it works or not. Quick note on who qualify. VA loans, anyone can assume. Doesn't matter if you serve. FHA, you need a 580 credit score. Your debt to income ratio has to be under 43%. And you've got to live in the property for 1 year. Expect 60 to 90 days to close. Some servicers will drag their feet. Document everything. All right, here's what you actually do. 3 steps. Step 1, go to withrome.com. That's the Rome platform, or assumable.io. Both are free. Plug in your zip code and see what comes up. Step 2, run the same search on Zillow. Count the results. Step 3, compare those two numbers. That gap between them, that's the information edge you now have over 99% of buyers in your market. Now let's talk investors. I know a lot of you are listening for this part. Think house hack, find a duplex, triplex, fourplex with an assumable FHA loan. Move into 1 unit, live there for a year. That covers the residency requirement. Your tenants in the other units, they're covering your mortgage the whole time. After 12 months, you move out, you keep the 3.25% rate, and now you've got a fully rented property financed at a pandemic era interest rate. That is a powerful position to be in. But I need to be straight with you on something. FHA's primary residence requirement, that's federal law. It's not a gray area. If you're going to house hack, you live there. Don't fudge it. Be honest about your intent. One more thing. If you caught episode 113, the 6.3% trap, you already know. Lending standards tightened hard. DSCR minimums went up. LTV thresholds came down. A lot of deals that penciled 18 months ago, dead now. This is the workaround. Your challenge today, do this tonight. Tonight. Not this weekend. Go to assumable.io. Type your zip code. Find one listing under 4%. Then pull up any mortgage calculator. Bank rate, whatever you use. Punch in their rate, then punch in 6%. Write down the difference. That number, that's your rate inheritance. If it's $400 or more a month, you just found something most people don't know exists. Screenshot it. Send it to somebody you know who's been complaining about rates. Next episode, half of millennials say they'd buy a home with asbestos in it. Half. What that tells us about demand and where the smart money moves next. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.